Wednesday, August 24th, 2021, Monaco 64, home of alternative economics and contrarian views. Today we're going to look at whether investors, not just in the US, but all over the world, are starting to lose faith and confidence in the Federal Reserve. It might sound like a little bit exaggerated, but I think we need to look at this. There's an article that I saw yesterday in the FT about the U.S. Treasury market, the $22 trillion Treasury market. And there's a bit of trouble in that market. And as many of you know, I used to be a bond broker. I used to trade Treasury bonds, notes, and bills. I used to trade Treasury futures. And I do know what I'm talking about here, and I understand what's going on. So we'll go over that today through that article, and then we'll look at the markets. Yeah, Billy is here. He's going to have his groomer come today, mobile groomer. So tomorrow he's going to look a lot cleaner. He's going to smell a lot nicer. Yes, I haven't been feeling very well. I have been taking vitamin C and D. Yes, I have. And just taking a lot of liquids. But I feel a lot better today. My throat's a bit blocked. So you might have noticed that I've edited the videos a little bit because I have to stop and drink something because it's difficult sometimes to keep going. But anyway, it's nothing serious, just a bad cold, I guess. And they talk a lot about liquidity in this article, and we'll go through liquidity first. I'm going to explain to you what liquidity is. It seems very basic for those of us who know the markets, but some people don't. And that's the thing that I try to do on my channel, is to explain things to people that might not understand it. Basically, liquidity means if I call my broker or use my electronic system, trading system, and I want to buy or sell a security or a treasury bond, note, or bill, I will ask the broker, where is the market? And he will say, well, it's 100.25 at 0.26. And what does that mean? Well, the bid is at 100.25 and the offer is at 100.26. So you can either sell it at 100.25 or you can buy it at 100.26. That's the spread between the bid and offer. And he'll say, well, there's 10 million on the bid and 10 million on the offer. So there's plenty of size or volume on the bid and offer, and the bid and offer is very tight. That means liquidity. And why is it important? Well, because big investors want to know that they can liquidate their securities very quickly and very easily. And if there is no liquidity, they can't value their securities. And yeah, the markets are in trouble. And treasuries are at almost, and I say almost because I'm going to show you John Exter's pyramid. They're almost at the base of the financial system in terms of being the most safe securities, the most liquid, the ones that have the most depth in the market, the most volume to trade. People should not have to worry about liquidity in the U.S. Treasury market because as you can see here by John Exter's inverted pyramid, what does it say here about this pyramid? And it's a pyramid of liquidity, I would say. It says Exter is known for creating Exter's pyramids, for visualizing the organization of asset classes in terms of risk and size. In Exter's scheme, gold forms the small base of most reliable value, and asset classes on progressively higher levels are more risky. The larger size of asset classes at higher levels is representative of the higher total worldwide notional value of those assets. While Exter's original pyramid placed third world debt at the top, today derivatives hold this dubious honor. Yes, derivatives are also a huge part of the Treasury market. Most hedge funds, speculators, and even investors that manage people's money, they do hold the actual Treasury, but they trade a lot of the futures and also the derivatives like the swaps and other things that are based on Treasuries. They're just bets. But if liquidity in the underlying Treasury market starts to wane, if there's not much volume to trade, it creates volatility because you might get PIMCO, one of the largest bond funds, calling their bond broker and saying, we've got $2 billion of 5-year notes to sell, and they can't get a price. And they might sell, but it might drive the price a lot lower than it normally does. Normally, if they want to sell $2 billion 5-year notes, it should be very easy. And the other way around as well, if they want to buy, they might not get a price. And I think that shows that the people, the primary dealers that are supposed to make a market, and what does making a market mean? Well, it's when you call someone, a primary dealer, and ask him for a quote, and you don't even have to tell him if you're going to buy or sell. He has to make you a bid and an offer, at least a primary dealer worth his salt or her salt has to do that. They might try to read you, of course, when you call them. If the markets are dumping, if they're selling and you get a call, you might kind of imagine that they might want to sell, so your bid is going to be a bit lower. So that's how it works. So the fact that there is trouble and the FT is writing about it is significant in my opinion. And it might sound strange that there's trouble in the Treasury market right now with yields so low and with the auctions going really well. We look at auctions that the Treasury does, and investors are taking up a lot of securities. But I think it bears watching, the fact that this is happening, and especially with Jackson Hole coming up. It's not going to be held at Jackson Hole, of course. It's going to be a virtual one, and Jay Powell is speaking on Friday. So let's go through this article. It says, trading conditions in the $22 trillion Treasury market worsen ahead of Jackson Hole. So it says, lousy liquidity sets stage for choppiness when Fed Chief Jay Powell speaks this week. Choppiness, yes, it's volatility. Trading conditions in the $22 trillion U.S. government bond market, a bedrock of the global financial system, have deteriorated as traders brace themselves for a key speech this week from Federal Reserve Chief Jay Powell. Liquidity, or the ease with which traders can buy and sell bonds, has worsened as a series of jerky price movements and uncertainty over Fed policy have kept investors from making big bets. Thin trading volumes, with many market participants out of the office in August, have exacerbated the problem. Yes, sometimes in the summer, the markets aren't as deep and as liquid, but I think there's more to it than that. Let's continue. The Treasury market is the biggest, deepest, and most important bond market in the world and acts as a benchmark that is used for pricing trillions of dollars of assets globally. And they also price derivatives, which are in the quadrillions, I would say. Policymakers and investors have been scrutinizing trading conditions following the market turmoil in March 2020. And before I go further, just show you what happened in March 2020. So as you can see here, last March, Treasury yields or prices, because when yields go down, for example, prices go up and vice versa. But you can see here that in the beginning of March, the 10-year yield dropped to like 0.3 almost percent. And then a few days later, it was at 1.1 and then at 1.3. And then it dropped back to below 0.9. It was trading like a junk bond basically does in a very risky, illiquid, and high volatility market. So even though yields are still really low, that was a bad thing because it affects all the derivatives out there. And as I've said many times, and you can go to my derivatives file, which is in the playlist, and I've spoken a lot about derivatives. They're highly leveraged, and investors, traders, they have huge positions in them. And if there's a lot of volatility in the major underlying asset class for derivatives, which is Treasury bonds, people will lose a lot of money. And that's why the Fed had to intervene last year, and that's why they're worried again. So let's keep going. So this is about March 2020 last year, in which abrupt falls in liquidity contributed to the acute volatility in treasuries. A severe sell-off earlier this year highlighted how difficulties have persisted even as markets more broadly have steadied. The recent drop in liquidity comes as Powell is set to deliver a speech at the Jackson Hole Summit this week. Typically one of the biggest events on the year's economic calendar. Reduced liquidity matters because it can lead to big price swings. So now it says, and I quote Andrew Brenner, liquidity is lousy, Andrew Brenner says, head of international fixed income at Nat Alliance Securities. And it could absolutely cause potential problems next week if Powell has something big to say. That's according to Mr. Brenner. Bid-ask spreads, that's what I was talking about earlier, for benchmark 10-year note and the 30-year bond in early August hits 5.5-month highs. That's significant. The spreads are now slightly off those levels, but remain elevated and have been widening again in the past week. Since the Treasury market is so actively traded, and it's also traded all over the world. It's been traded right now in London. It's traded in Asia before London comes in. It's traded in New York. It's a 24-hour market. This gap, which tracks the difference in the price buyers are willing to pay and the price at which sellers are offering, is typically narrow. Gunit Dhingra, head of U.S. interest rate strategy at Morgan Stanley, said bid-ask spreads had been widening for two reasons. So I'm quoting him here now. Says the first is that this is the month of August and volumes are typically lower in August. And also I think markets have become somewhat perplexing to investors as people have a higher degree of risk aversion. In the past week, Goldman Sachs liquidity index for 5 and 10-year Treasury notes fell well below their 21-day average. Another liquidity metric, JP Morgan's gauge of market depth, has also recently fallen to the lowest level since this March. At the same time, JP Morgan analysts said last week that individual trades were also having a bigger effect on prices. The ability to buy or sell securities without causing big changes in price is another indicator of liquidity. Yeah, and that's right. I remember when I traded treasuries, trading 100 or 200 million or a billion 2-year notes is very easy. It gets harder, of course, the longer the maturity is. It's less liquid than the shorter maturities. But this is concerning, and the fact that people at JP Morgan and Goldman Sachs are talking about this, that things aren't as good as they should be. Minutes from the Fed's most recent policy meeting revealed disagreement between members about when the central bank might begin withdrawing its $120 billion in monthly asset purchases. The first step in unwinding its crisis-era support for the economy. Investors will be watching Powell's Jackson Hole speech on Friday for any signs of a decision on the timing or pacing of that taper. It is not just August trading volumes and uncertainty about the Fed's path that have dried up liquidity. A fall in Treasury yields since mid-May has baffled many investors because it has come even as many economists and the Fed itself have a sanguine outlook for economic growth and the labor market. Yeah, people are kind of puzzled because you've had inflation going up, you've had CPI almost at 6%, you've had these Fed officials and economists saying the economy is going to pick up, and yet Treasury yields have dropped from 175 to around 120 now, and that doesn't make sense. People are confused and they don't want to participate in this market. I think it shows that the market is artificially propped up and investors can feel that. It's like they're looking out at the ocean from a beach. They know that there's a storm coming, and they're being told by the people who run the hotel, they want people to stay on the beach and spend money in the bar. The people at the hotel are saying, oh no, don't worry, everything's fine, you can stay here. But they're not convinced. That's the way I think things are right now. So, and it says many clients have not particularly understood how rates markets have moved, and that has brought in a degree of caution you wouldn't normally see, said Dingra. So there you go. Yeah, I think the Federal Reserve has a problem here. Investors are starting to lose faith and confidence in this market. Does it mean it's going to implode and collapse? No, but we need to keep an eye on treasuries. Most people don't look at the treasury market, but it's the most important market for all asset classes. So yes, it looks like everything's normal now, yields are low, but underneath the surface, the fact that the FT is talking about this, I think it's quite significant. So let's look at where the markets are this morning then. It's 8:20 a.m. London time. Yes, yesterday gold and silver did rally quite well. I think the key level now is 1832 on the upside. And then around 1860. Right now we're at 1803.60. It's down just under $2. The range has been relatively narrow overnight, 1806.50 to 1800. Silver is down 2 cents at 23.60. Range has been 23.50 to 23.68. Futures are higher this morning. Here in London, the Dow futures up 86, the Nasdaq is up 66, and the S&P futures up 12 points. FTSE is up 8 points at 71.20. Yeah, the dollar came off a little bit yesterday, generally speaking, as well. Today, things are a little calmer. Sterling is unchanged at 137.26. The euro is down slightly at 117.40. Dollars up slightly versus the yen at 109.78. Dollars unchanged versus the yuan at 647.81. And The Aussie dollar is up 1/3% at 72.33. The dollar is down 0.2 versus the Canadian at 126.23. And the Kiwi dollar is up 2/3% actually, almost back up to 70. We're at 69.36. WTI crude is up 1/4% at 65.75. High grade copper is down 0.5%, just below 420. And to finish off, the 10-year yield is trading at 1.27%. It's up just over 1 basis point. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.